Let's talk about the cost equation. So again, like playing devil's advocate right off the bat, passive ETFs to gain exposure to the equity market are very cheap.
Yep.
We haven't quite gotten to the point where investment managers are paying us to use their products, but we're basically there. You can buy the S&P 500 for 2 basis points now. So that in and of itself is not an argument to not utilize ETFs in any capacity. But when you start layering on the transparency and eventually what we talk about in terms of efficiency, this story holds. But more specifically on costs, what does it cost to own a stock, Matt?
Yeah, that's the beauty. It's zero, right? The cost of owning a share of Home Depot to you is zero. It's just in your portfolio. You're not paying a middleman. It's zero.
Right. So no more transaction costs, at least for the most part. You're not technically paying a manager if you're just buying and selling stocks in a brokerage account. And that compares to, let's just say, actively managed mutual funds, where depending on the actual asset class you're looking at, it can be pretty expensive. And I think that's a bit underappreciated because although it's not an expense that shows up on statements, again, here's a lack of transparency.
It does not show up on statements.
It shows up in performance.
Right.
And so let's say you have an 85 basis point management fee. That's going to get subtracted from performance, and it's just a higher hurdle for you to clear in terms of your investment gains. So I think that's pretty important to consider. And even though costs have come down, it's still very much a factor, at least in the active space in equity markets.
Yeah, no doubt. And, it really does need to be paid attention to because oftentimes these expenses aren't overly easy to find, right? They're, like you said, they're not on the statement. Most people aren't going to go through the exercise of taking 8 mutual funds in their portfolio and going and getting all the expense ratios off of, the fund company website and then modeling out the weightings of each fund to get themselves a weighted expense ratio for their overall portfolio. We do that, but rarely have I come across a client that's brought a portfolio outside in that says, hey, take a look at this, and they've already done that exercise.
Yeah.
So it's not transparent. You do have to dig a little bit. And it is the cost of doing business for outsourcing some portion of portfolio investment.
Yeah. And let me be very clear. I do think there are certain markets where it very much does pay to go pay somebody else.
Yeah. It can pay. Yeah.
Our expertise, at least at Blue Chip Partners, where we feel the most benefit to our clients in terms of actually going out and identifying that basket of stocks is in the domestic large cap space. Now, when we start talking about other areas, small cap, international markets where we are not boots on the ground, all of a sudden, when you look at some of these markets that are, by the way, meaningfully less efficient than domestic large businesses, it does generally, I guess it can pay to go active and pay somebody else. Now, there is still good and bad in those spaces. But again, we are making that decision on behalf of our clients because if we are going to outsource money, and Matt can attest to this, we do some serious due diligence on who we're actually going to trust and partner with externally. It's not just throwing a dart at a dartboard. This is weeks, sometimes months worth of due diligence in terms of finding a partner, an external manager that not only can provide good absolute benefit, but also how does it work with your existing allocation?
Yeah.
So the cost is certainly a factor. It shouldn't be the only factor, which is why we're saying don't just blindly go pay 2 basis points for a passive ETF. But it should be considered in the grand scheme of things.
Yeah, no doubt. And then, where it even gets more issues compound is when you'll see some portfolios and they'll have 5 different large cap mutual fund managers. And then we just have this unintended concentration. You have one manager selling Microsoft, the other manager buying Microsoft, all the while the investor is just paying, what could be considered an unreasonable fee for, a overly diversified portfolio that's incredibly inefficient from a tax perspective.
Yeah, there's diversification and there's diversification, right? Just diversifying for the sake of diversifying.
Yeah.
So efficiency. When I talked about, the 3 buckets that we want to talk through in terms of why we think it's beneficial to utilize individual stocks is your equity allocation. The last thing I mentioned was efficiency. And a lot of what we talk about with regards to efficiency does relate back to taxes. Do you want to start that conversation?
Yeah. So, I think the premise here is most people can relate to the fact that most of the time stocks tend to go up. Most stocks tend to go up, but not every stock's going to go up, right? So if we buy 40 companies, maybe 30 of them were positive in that calendar year, 10 weren't. We can take action, assuming in a non-qualified, non-retirement account, we can take action on the tax side at the end of the year or throughout the year to tax loss harvest the portfolio. And this can have an incredible advantage for investors over the long run. And I believe it's something that people should absolutely understand and should be a feature of people's investment strategies. But under that premise, we're mostly investing in business that go up. Some don't all the time. It's our job as a manager to harvest those losses. So when stocks work against us, it's our job to harvest the loss. Now we get to bank that loss that we harvested and kind of set it aside. And we can let those losses build up on tax returns, on carry forwards for years. And I always think of the great, a situation where an individual sells a business or they want to buy a house and they want to take a large amount of money out of the portfolio to do so. That will necessitate taking gains. And, again, in a non-retirement account, taking gains means paying some tax. Those losses will offset that we have perhaps over the course of 5 years, those losses will compound and we'll eventually be able to offset that gain for a business sale or potentially, a second home purchase or something along those lines.
Right.
So it's a great feature from the investment side that investing in individual stocks has.
Yeah. And, that's something that we do on a monthly basis where we sit back and we basically survey the entire firm's exposure and try to identify if there is a specific company or set of companies in which it would be beneficial to harvest losses and reap that tax benefit. The next step is to actually review if you want to continue holding that after a 30-day period that's necessary to reap that tax benefit. But the whole idea is that's a very different process that you would experience relative to just partnering with an actively managed mutual fund, right? So when we go and make these changes, we've identified a set of individuals who this tax loss would benefit. We've identified individuals who might still hold this and it's at a gain. We're not going to sell it for them. The reason I say all this is because with mutual funds, the intricacies around taxes are a lot less clear. And intra-year, yes, there might be some semblance of loss realization, but more likely than not, there's going to be a portfolio manager based somewhere else that's, again, not considering Mary and Joe Smith. And when they go out and sell something at massive gains, they don't really care about your own financial situation. They don't care that you also have to recognize gains to pay for that house that you're planning on buying. And so that doesn't get recognized by the investor immediately. But at the end of the year, a mutual fund might pay out the actual capital gains distribution, right? Based on the gains that they realized over the course of the year. Could be very small, could be 1%, could be a lot higher, could be 5% or more, which again, in the grand scheme of things might not be that big of a deal. But the idea is, as an investor, no one's going to know if it's a big deal for me unless I'm having an active dialogue with the individuals that are managing the assets, right?
Correct.
Which is why that tax efficiency conversation to me is really only possible if you're in this business, which is helping to prepare folks financially and grow wealth. It's not possible unless you are the one actually making the decision because you're having a dialogue with the end investor. The mutual fund firms and the portfolio managers of the large mutual funds just simply aren't doing that. They're not expected to do that. But,
right.
That's a very big part of the conversation to me.
Yeah. At the end of the day, that tax efficiency can go a long way for people. It can be utilized in a number of different cases. And at the end of the day, it's what you do 5 years prior to the need from that portfolio can ultimately have a large tax impact on kind of what you're doing in present day.
Yeah.
So it's something that needs to occur all along the way, year after year after year, so that the payoff, whenever that's realized, will be significant in the form of tax savings for clients.
Yeah, absolutely.
And investors, yeah.